Welcome to this definitive explainer on fraud risks. Today, we're diving straight into the comprehensive internal auditing curriculum of instructor Same Harakli to make sure we don't miss a single crucial detail. Whether you're trying to understand the mechanics of corporate deception or you're actively defending your organization, we're going to break down exactly how fraud works, how it's stopped, and how it's hunted. Let's get into it.
Okay, taking a quick look at our agenda, we're going to tackle this in 3 linear steps: fraud risks and types, fraud controls, and finally, fraud investigation. So let's jump right into part 1, 10.1 Fraud, Risks and Types, where we'll explore the current fraud landscape.
Look, to effectively fight fraud, we first have to strictly define what it actually is. According to the IIA, it's not just a mistake, and it's certainly not just a lapse in judgment. It is an intentional act characterized by deceit, concealment, or violation of trust to secure an unjust advantage. And here's the absolute key. It requires 3 specific elements. You need an intent to defraud, the actual commission of the act, and the accomplishment of it. Without all 3 of those, intent, act, and accomplishment, it just doesn't meet the formal definition.
So how do those intentional acts actually come to life? Well, usually it's through the fraud risk model. You can think of it as a perfect storm of 3 overlapping elements. First, you have opportunity, which almost always stems from weak internal controls. Then you have situational pressure. That's the motive, like a personal financial crisis or intense pressure to hit a corporate earnings target. And finally, rationalization, which is the psychological ability for someone to justify their dishonest actions to themselves. When opportunity, rationalization, and pressure all combine, the risk of fraud is incredibly high.
And today, that opportunity element has absolutely exploded thanks to digitalization. We aren't just dealing with someone skimming cash from a register anymore. The entry points have multiplied into a rapid-fire list of threats. Beyond your standard phishing and email spoofing, we're now dealing with vishing, where scammers actually use phone calls, smishing, which uses text messages, and the frankly wild reality of quishing, which is a highly deceptive attack where scammers use malicious QR codes to bypass your security entirely.
Beyond those digital attacks, we also have to understand the sheer density of traditional fraud types. You have asset misappropriation, which includes things like defalcation, embezzlement, or pocketing cash before it's even been recorded. Then you have massive financial statement misrepresentations. A classic example is channel stuffing. That's where you ship products a distributor doesn't even need, just to record a fake sale for the quarter. And of course, there's corruption, which covers bribery and undisclosed conflicts of interest that just rot an organization from the inside out.
Now, you might be wondering who is actually pulling this off. Notice the stark contrast here in who commits these crimes and why. Low-level fraud is typically your staff employees stealing property or cash, and it's very often motivated by personal economic hardship. It directly benefits the individual. Executive-level fraud, on the other hand, that involves executives manipulating financials to boost stock prices or hit massive bonus targets. Ironically, this type is intended to benefit the organization's public appearance, even though, in reality, it's deeply, deeply destructive.
It's also absolutely crucial that we separate symptoms from red flags. They are not the same thing. Symptoms, like an employee suddenly flaunting unexplained wealth, noticeable behavioral stress, or documents that clearly look tampered with, indicate that fraud might already be happening right under your nose. Red flags, however, things like missing records, rapid turnover in the finance department, or just generally weak IT controls, those signal that the opportunity is ripe. A red flag doesn't guarantee a fraud has occurred, but it absolutely screams that you have a vulnerable environment.
So whose job is it to stop all of this? The truth is, everyone has a part to play. The board sets the tone at the top and evaluates the anti-fraud activities overall. But look closely at management. They carry the primary, heavy-lifting responsibility for establishing, monitoring, and controlling the actual processes to prevent and detect fraud. Senior managers are right there in the trenches with them, implementing those controls day to day and establishing clear escalation procedures for when things inevitably go wrong.
There is a very strict separation of duties here that we need to acknowledge between management and internal audit. Management is responsible for actually preventing the fraud. They design the controls, they implement them, and they build a fraud-resistant culture. Internal auditors do not design those controls. Instead, your job as an internal auditor is to evaluate the adequacy of those controls, raise awareness, and exercise rigorous professional skepticism. You are the independent set of eyes confirming if management's defenses actually hold water.
All right, that brings us to part 2, 10.2 Fraud, Controls, where we learn how to actively defend the organization. Building those defenses means you need a robust fraud management program with several functioning components. You really can't rely on just one single thing.
You need a strong company ethics policy that sets a definitive tone. You need continuous, tailored fraud awareness training for all employees. And you absolutely need rigorous, documented fraud risk assessments to identify your priority vulnerabilities, which are then followed up by ongoing reviews and strict investigation protocols.
But listen, even the absolute best program out there has a fatal vulnerability, and that is management override. This happens when the very executives who set up the controls decide to bypass them for illegitimate purposes. Think of a manager pressuring the controller to keep the books open past period end to manipulate the cutoff, or simply altering adjusting entries to artificially decrease expenses. Mitigating this specific risk is incredibly tough. It requires a strong, anonymous whistleblower culture and a highly effective, totally independent internal auditing activity. To prevent those overrides and everyday theft, we've got to implement some highly specific, rigid rules. Take purchases, for example. We mandate blind receiving copies. This means the receiving department actually has to physically count the goods rather than just lazily checking a box that says received. To fight computer fraud, we use strict device authorization tables to ensure someone on the manufacturing floor can't just access accounts receivable data. And segregation of duties? That ensures the person signing the checks is never, ever the same person receiving the goods. Which brings us to our final section, 10.3, Fraud Investigation. Because when the controls fail, how do we uncover the truth?
Once a suspicion of fraud is actually documented, investigations, which are usually led by internal auditors or legal counsel, kick off with incredibly strict objectives. You have to determine if fraud actually occurred, you need to quantify the financial loss exposures, find out exactly who was involved and exactly how they did it. But above all else, you must preserve the evidence meticulously through an unbroken chain of custody.
A massive part of that investigation is the interview protocol. And guys, this is not a normal fact-finding chat. It is highly specific and high stakes. First, you gather all your relevant evidence before you even sit down. You always have two people conduct the interview. You guide the suspect carefully from broad open questions down to highly specific closed questions. You never make unprovable accusations that could create legal liability for the company. And crucially, once that interview is over, you never let the suspect return to their work area where they might destroy evidence. Beyond the interviews, auditors use some pretty advanced, honestly almost magical mathematical methods to hunt down anomalies. Take the first digit test, for example. In nature, numbers actually start with a 1 about 30% of the time, while the number 9 occurs first only about 5% of the time. But assigned fraudulent numbers? They often break this natural rule and start with the 6, 7, 8, or 9 way too often. Combine that mathematical anomaly with discovery sampling for finding rare items and structured query language data analytics to search for duplicate payments, and the auditor becomes incredibly dangerous to the fraudster. We also rely on advanced real-world techniques like ground truth testing. This is incredibly powerful because it steps completely away from the spreadsheets and compares the theoretical corporate policy against actual real-world facts and direct on-the-ground observations. You also have pressure testing, where auditors actively assess if insanely aggressive corporate goals are creating a high-pressure work environment that's basically acting as a catalyst for fraud.
Ultimately, manipulating financial statements always leaves tracks. By comparing financial data across prior periods, measuring it against industry averages, and critically associating it with non-financial metrics, like say comparing recorded revenue against the actual physical shipping logs, auditors can uncover those glaring logical gaps that are often hiding massive systemic frauds.
So, when all the evidence is finally gathered, we reach the aftermath. The chief audit executive formally reports the findings. Sometimes they even keep drafts addressed specifically to legal counsel to maintain attorney-client privilege. From there, it's entirely up to management and the board to execute the resolutions. And we're not just talking about a slap on the wrist here. Resolution includes terminating supplier contracts, demanding full financial restitution, or filing civil suits and formally reporting to law enforcement.
However, there is a hard, critical professional boundary you have to remember here. Internal auditors are perfectly positioned to evaluate and express a formal opinion on the adequacy of the organization's fraud controls, but it is strictly inappropriate for an internal auditor to ever express an opinion on the legal culpability or the legal intent of a fraud suspect. That ultimate determination belongs exclusively to the judicial system, not us.
As we wrap up this explainer, I want to leave you with a final thought. As you step into the field, analyzing those first digits, searching for red flags, and constantly questioning management overrides, how will you balance the relentless professional skepticism required to catch these deceptive schemes with the absolute necessity of maintaining a healthy culture of corporate trust? Think about that as you process everything we've covered today. Thanks for joining me.